Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So within this risk appetite, you have an offshore growth opportunities that's driving the appetite, and you have U.S.-centric growth opportunities driving it. The last time we saw the U.S.-centric growth opportunity in a risk appetite environment was the bull market in the U.S. dollar from 1990 to 2002. And it was driven by the U.S. stock market. Everybody wanted to get involved in U.S. technology. Everybody wanted to get involved in the NASDAQ. Money was flowing into the U.S. in a very, very big way. So this was a risk appetite period in which the growth was U.S.-centric, and therefore the U.S. dollar moved higher in a 10-year bull market, in fact, based on the U.S. dollar index. Right now, we are right here, obviously, in this offshore growth opportunity. Money moving out to the emerging markets in Asia. Most of the opportunities are out there. Slower growth in the industrialized world in general relative to the U.S., relative to those emerging markets out there. So money tends to move, more money tends to move offshore, and the Fed is creating that money through the quantitative easing in order to allow a lot of that money to move offshore. Bigger supply of dollars, more money going offshore for the growth opportunities tends to put pressure on the dollar going lower, and that's what we're seeing, obviously, in a very, very big way. Now we also have risk aversion, and that's the flip side of risk appetite. That's when all of a sudden investors get scared and have to take some money off the table. Well, in this idea, and we've seen it already with the credit crunch as one example, when we have offshore growth opportunities in a risk aversion period, kind of settles in, meaning the credit crunch was an example of a massive risk aversion that we haven't seen before in our lifetimes. Needless to say, it was a creme de la creme of risk aversion. But when we saw it was a stark example, because what happens, money comes back into the U.S. market in order to hide when it's offshore. It can't hide in those offshore markets because they don't have deep capital markets. They don't have what we'd say high-quality, risk-free government debt that's available to major institutions. So the major institutions have to come back and hide in the U.S. Treasury market, especially when we see that type of risk aversion on that type of scale. And in general, because the U.S. dollar is the world reserve currency, and this is an important point, there's a lot of dollars out there offshore. Not only do domestic investors, domestic U.S. investors, whether they be individuals, pension funds, mutual funds, and hedge funds, come back into the U.S. Treasuries into cash when things get dicey out there, but you also see the investors in their local markets that don't have adequate capital markets to hide move their money out of their local markets into the U.S. Treasuries. So you get money flow not only from the domestic side that has moved money offshore, you get money flow back into the U.S. from people in local markets looking for a place to hide. Now, when you have risk aversion in a period when the growth is U.S.-centric, again, something we haven't seen for a while, and it's hard to even think about, but it will return someday, I think. When we see that, you could have two situations. You could have the U.S. dollar actually move on a risk aversion situation when the U.S. is growing, or you could see the dollar fall. Let me give an example of when we saw the U.S. dollar fall. We had a decent amount of growth opportunity, or at least forward momentum in the economy in the 1980s, of course. The dollar was still in a bear market, so to speak, until 1990, but we had the 1987 stock market crash, and it was a little bit of a triple whammy for a while, meaning people wanted to run out of U.S. assets in general. Bonds getting hit, stocks getting hit, the dollar getting hit at the same time. So you can have both situations when the U.S. is kind of the growth-centric driver. If the U.S. is the center of the problem, when it's the growth-centric situation, we could see, a short-term run out of U.S. assets. In general, because the U.S. is the world reserve currency, and because of that depth of the capital markets, it doesn't usually last long. It tends to be a bit of a fear move. The main beneficiary, and when we see the U.S. as a source of the problem when it's also the growth driver. Europe in general, because Europe has the second biggest capital markets, and also Japan. The Japanese yen tend to do well on a relative basis when we see that. Again, we haven't seen that environment for a while, and we're not in that environment at the moment. We're in this environment right here. We're off where the growth is offshore at the moment. So in both situations, the growth is offshore. But we can see these environments, so just stay open to that. Special situations, and I'll get into this a little bit later, but we see country-specific situations that can have impacts on individual currencies. Odd things can happen out there in the world that are irrelevant to what the major global macro themes are out there. So there are those country-specific situations in which a particular currency may benefit or get hit very, very hard relative to the rest of the pack of currencies. So that's something you have to be open to, and I think if you're open to that and can identify something like that early, they really are great trading opportunities in general. Not always easy to spot, obviously, but in general are great opportunities if you stay open to them. Let's first examine this in what currencies I think will work in this idea of risk appetite. And again, this is no surprise. We've seen it. The growth driver is offshore. At the moment in the current cycle, it's Asia and emerging markets are driving growth. What you want to own against the U.S. dollar. The commodity currencies. The commodity currencies in this environment where the growth is offshore, driven by Asian and emerging markets because of their commodities component, you want to own the commodity currencies, and they've been the biggest movers in this cycle so far and continue to be from a relative standpoint. Australian dollar is really the major, in terms of the major currencies, Australian dollar is one of the majors. The major currencies consist of the Japanese yen, the euro, Swiss franc, British pound, Canadian dollar, and Australian dollar. Those are considered the majors. There are other active currencies that can be put in that class. New Zealand dollar is pretty actively traded, so it's pretty close. But those are the majors. So of the major currencies of the world, the major dollar pairs, the Australian dollar is the key risk appetite currency. It tends to do the best when growth opportunities are offshore and risk appetite is high, and you see that. All you need to do is look at a chart of the Australian dollar in this particular cycle. It was hit the hardest during the credit crunch, and it's moved up the fastest when growth has gotten back into gear offshore in Asia. Makes sense. China's demand for as much as Australia can dig out of the ground just continues in an insatiable way. So therefore, the Australian economy benefits the most. Because the economy is benefiting, the central bank in Australia has to tend to keep interest rates higher relative to the other countries around the world so it doesn't overheat. So you get a yield advantage in the Australian dollar, higher interest rates, which brings money in. You have a growth advantage. You have that constant secular demand for commodities from China, and the economy tends to grow faster than the others, and we've seen that. So it's played out in a very, very big way. So that's obviously target number one. And the other commodity currencies play the exact same role. New Zealand dollar, very similar, not the exact role. There's different components of their economy and different strengths, but very, very similar role. They're in that basket of commodity currencies. That's the basket you want to own in this environment. Brazilian real, which Steve just talked about, which now is going to be available on the ISE, is another great one. It moves very, very fast. And given the outlook for the Brazilian economy, if some reason the secular growth pattern in emerging markets doesn't continue, Brazilian real can change, but it sure looks like, given the secular multi-year growth patterns out there, the Brazilian real will remain supported, even though it may back up in here because it's moved very, very fast, very, very far. And that's one of the beauties of the Brazilian real relative to these others. We haven't really tracked the Brazilian real relative to the Australian dollar, but because it's a smaller currency on a relative basis and less liquidity, it's going to tend to move faster on the upside and downside and be a little more volatile, which is not a bad thing for you when you want to trade options. So that's a nice one right there, part of the commodity currency class.
Thank you for participating in this week's session. Please join us again next week. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.